Okay, so I got a response from Ms. Merck. Yeah, to everyone. Yes, please, they have. Okay, so let's begin with the introduction to accounting and business decision making. In this presentation, we will, we will talk about how the accounting process works and how the accountants can help in the business decision making on the daily basis, and how this whole process works. So first of all, let's have a brief look about what the accounting process is. Sorry, I got disconnected. Is everybody?
Yes, no problem. Yes, we can hear
Okay.
you perfectly. No problem. If it happens again, we'll look for you in the
Right,
waiting room,
right.
and
that'll
that's
be
no
also
problem.
also kind of you. Okay, so the accounting process is basically is integrated with the 4 sub-processes. First of all, you have to identify the transactions that affect the entity's financial position. You have to identify the entity, and all the transactions which are happening in a business on a daily basis, they must be reliably, credibly measured and recorded appropriately. The identification of an entity is different from the owner, and that is the first step. For example, if you've got a company ABC Limited, you would say this ABC Limited is a company, is an entity, and if 3 people are running it, if they are the owners, you would say that this entity this is the entity ABC Limited, belongs to 3 people. Entity is separate, has got a separate identity, in which dedicated transactions are being done on a daily basis. And the importance of this accounting process emphasizes upon the fact that you have to measure the transactions in a reliable manner, and that's where we have to analyze, record, and classify the business transactions. And once the most important criteria about measuring is that basically it's based on 2 principles. First, it should be reliably measured, and once it's been measured, then you have to record it. You have to put it into the documents. And then the third process in the accounting is that you have to convey this information. You have to disseminate this information through various reports, such as profit or loss, which is otherwise called income statement, balance sheet, statement of financial position, the new name, more fancy names nowadays, and the statement of cash flows, which tells an entity how much cash, how much the liquid cash an entity has. It belongs to the, here I can quote an example of a famous company, Enron, back in at the onset of 21st century, they got bankrupted. And why did they got bankrupted? Because on the statement of financial position, they were showing lots of profits. They were showing that they're earning lots of profits, but actually, when it comes to the liquid cash, they ran out of cash, and with the help of their auditors, they did some bribery and other sorts of falsification of accounting records, and that's how they manipulated and falsified the accounting records and misled the investors, and it led to the bankruptcy of the famous company Enron, and also to the permanent disqualification of the Anderson, one of the top 5 auditing firms of that time. And then the last important thing is that you have to, you need to have this information, because why accounting is important, because with the help of this, you can, you can make decisions. With the help of this, you can make decisions, you know, and there are two types of people, there are two types of audience for which this accounting information is absolutely necessary: the external audience and the internal audience. You know, in the following slides, we will explore more about you know, who are the external users of this accounting information and who are the internal users. Can we move to the next slide, please?
Sure.
Okay, thank you. Now, okay, the business transactions, you know, can be what you can say that, you know, we can say that it is the exchange of something. You know, whenever, you know, it's about give and take. I give you something and I take something from you. It's about, you know, it's happening between 2 or more entities. It can be 3 or 4. That's what the transaction is all about, you know, give and take. And it basically affects the 3 fundamental, the 3 pillars of accounting, and they're called assets, liabilities, and equity. And that's what makes the classic accounting equation, the basis, or you can say the foundation, the bedrock of the accounting, which says that your assets are equal to liabilities plus equity. Assets are very much, you know, I don't need to explain it. Whatever you have, like your building, your infrastructure, your bank balance, your inventory, that's what, you know, comes under the definition of assets. And then the liabilities, the amount, the you know, that you owe to the, say, to the tax authorities, to the suppliers. And the equity is something, the capital of, you know, the ownership, you know, how much is owned by the owners, who are actually, when it comes to the company level, who are the effectively are the investors or the shareholders. So you know, to simplify it, I can quote an example here. For example, you have you've got a home which has been which has been allotted to you from a bank. So asset, what is the asset? The asset is your home, your entire home. Liabilities, for example, the cost of the house is $10,000 and you have paid $4,000 and you owe $6,000 more to the bank, which you have to pay in the next few months or years. And equity is something that you own. $4,000, you know, that's the 40% of the home that I own, and $6,000, you know, is the liability that I owe to the bank. So 60% I owe, 40% I own, and that makes 40 plus 60, that makes 100, is the entire home asset that that comes at the beginning. So the $10,000 home is equal to the 6,000 liabilities that I will be owing to the bank, that I'll be supposed to pay to the bank in the next few months or years, and 40%, $4,000 I own, you know, I've paid to the bank, and effectively I have 40% ownership in the house. Can we move to the next slide, please?
Sure.
Can you click? Just, did some animation in the slide, so just want it to be completely open. Okay, so accounting information and its role in the decision making. No previous slide, because first of all, let me tell you who are the internal users. Like I told you before, that this accounting information is meant to be prepared for two types of people: internal users and external users. So first, who are the internal users, and why this information, accounting information, is important for them. Ricardo, could you please make a click? Yes. Accounting information is extremely valuable to an entity's owner or management. For example, if you are running a company, if you are the sole owner of a business, of an enterprise, and you're running it, you will be, requiring that accounting information, that how much you have, how much you invested in this at the beginning, how much you have earned, how much you owe to the suppliers, how much cash have you got in the bank, and how much and how much you have to pay to the suppliers, and how much you have earned over the past, say, 3 months, since you started the business. So that's how it's very important for the management. At the company level, this information is very important for all the board of directors to have them to let them know that where the company is standing, and how much they have earned, how much how well they are performing financially, in terms of in terms of how much they have gained financially. And that's all. And can you move to the next slide? And yes, external stakeholders, external people, they are the people who have a vested interest in knowing about the accounting information or the financial information of a company. These stakeholders can include, for example, shareholders. For example, I've got like previous slide, please. Shareholders, why? For example, if I've got, for example, in Twitter, let's take the example of Twitter. For example, I've got like, say, 10% of the Twitter shares. So I like to know, I like to, go to the S&P 500 global, and I like to ask, what is the share, the price of share in today's, what is the price of each share today? Because I bought the share, say 3,000 shares, say 2 years ago, and at that time I bought each share at the price of, say, $10. Now, after 2 years, I'm interested, how much have I gained? This is called capital gain. How much I've gained, and how much the price of the share has gone up, say 20%, say $20 per share. So I would say, yes, it's 100% increase after 2 years. So on each year, I've earned like my, this, with the help of accounting information, when I'll read it, I'll come to know that how well the company has done in the past 2 years, how much profit they've earned, how much revenue have they earned, how much losses have they incurred. This type of information this will give me an idea that how well the company has been performing. And then the customers, obviously, and same goes to the suppliers and banks who are gonna lend you big amount of loans and other corporate bonds, and suppliers, usually, when you're working at a big level, at a company level or in the manufacturing industry, you have to work on a credit basis. So, I mean, they would like to know the credit worthiness of your company, and that's why they would be interested to know that how well your company is been performing. Are they performing okay, or are they incurring any losses at the moment? How well they perform? So they will be interested, because they have to give the loan and they have to make sure that tomorrow that you will be able to give them back. And employees will be interested, because they would like to know that if I'm working in the company today, what is my future in the company? Will the company survive in the future or not? You know, for example, Lehman Brothers, one of the top banks of United States, in the 2007 and 8 financial crisis, they got collapsed, and it was such a big financial institution, and everybody who was working at the at the Lehman Brothers in 2007 and 8, they were really shocked. And if I were working at the Lehman Brothers, I would probably say that yes, I'm working at Lehman Brothers, and how I would I be proud, because I would see that I would see it through the accounts, through the financial information of the company. And then the government authorities would be interested to know that, for example, the tax authorities, the other compliance authorities, the environmental authorities, are they, working in compliance with the environmental standards or not, things like that. Next slide, please, Ricardo. Okay. This is something the stakeholders and the accounting information. Who are the stakeholders, and why do they need the accounting information in their decision making? Shareholders, I've explained above. This is a slide, just it can tell you that what sort of interest, why would they be interested in reading the accounting information, financial information of a company? Like I told you before, the shareholders, they would like to know what is the future profitability, the future flows of dividends, how much dividends I'm going to go, how much is the capital growth of the investment, like how much did my share worth 2 years ago when I bought at the price of $10 per share, and what is the share price now, which is a capital gain. Same like bank, whether the entity will be able to repay the loan, and the suppliers, same goes to suppliers, employees, consumers, and the government authorities, such as taxation authorities. They would like to know whether the company is paying the taxation, or is there any tax evasion happening, which is a crime, obviously. Regulatory authorities, communities would like to know that how much how generously the entity is contributing to the social welfare and the economic and for the economic prosperity of the local communities where they're working. And this is a table which actually would help you understand that why do they need this accounting information. Can we move to the next slide, please? Yes. Now, this is where the accounting is divided into two branches. One is called financial accounting, and the other one is called management accounting. I mean, there's no third type, and I don't think they will. I think there will never be a third type, obviously. These are the two branches, and it's very important to understand the distinction between these two branches. Okay. When it comes to the financial accounting is basically where you have to prepare your financial statements. Financial statements include income statement, how much you have earned, how much you have, what was your expenditure, what was your operating income, what was your how much you paid for the tax, etc., and how much was the net profit that you have earned at the end of the year. That's what the income statement is all about. And then we have balance sheet or statement of financial position, which shows the perfect accounting equation, which I told you the assets is always going to be equal to liabilities and equity. That's what I talked about at the beginning of this presentation. Can you make one more click, please? Okay, so it's what is the purpose of this financial statements, statement of cash flows, income statement, balance sheet. It basically, like I told you before, it gives the information to both to the internal and external users how well the company has been performing financially. Like I told you before, there are some internal users like management and employees. There's some external users, and the financial statements basically are of 4 types. The income statement, I told you before, it tells you that how much profit or loss, how much profit you've earned or how much loss you've incurred this year. Balance sheet tells you how much assets you've got, what are your liabilities, and what is the equity, which is the capital or the ownership or the amount which is owned by the owners of a company. In a typical company, these owners are called shareholders. And statement of changes in equity, which tells you that how much shareholders or the owners of a company owned last year. What was, for example, the share price doubled. So last year, if the equity was $20 million, this year, if the equity is $40 million, that makes that it means that they've made 100% profit, an increase in the equity. And once the equity will be increased, the profit will be added in the equity, and from that profit, the company is supposed to pay the dividends or the sharing of the profits, small sharing of the profits with the shareholders. If you must have heard this term that if somebody has got a pool of shares, they must be getting the dividends from a company every year. It's kind of a profit sharing scheme to incentivize all the shareholders. And statement of cash flows is very important. That forget about what is being written, that how much profit you are earning, how much liquid cash you have, for example, if you're showing, if like I gave you the classic example of Enron back in 2000, you can also read this case study on the internet, that how Enron was financially collapsed, because on the paper they showed that we've got like millions in the profit, but actually when it comes to liquid cash in the shape of bank balance or any corporate bonds, they had nothing, and their liabilities gone up, and their liabilities gone up, and due to this collapse, a special standard by the International Accounting Organization, they introduced a special accounting standard on lease. Before the collapse of Enron, if you've got a long-term lease, you can capitalize, you can show them as assets in your bank statement, in your balance sheet. But now, after the Enron collapse, now you can't show your leased assets as as assets. You will have to show the leased assets as liabilities, because you owe to the company or the entity from whom you have leased your asset. So can we move to the next slide, please, Ricardo? So we've talked about the financial information. Management accounting. Management accounting, how is different from the financial accounting? The other name for the management accounting is cost accounting. It's all about cost controlling, better improvisation, process improvement, business process engineering, so that you can reduce the cost and increase the profit margins.
And Professor Abrar, there's a question here from, I don't know if you want to take a couple questions as they come in. Would that be appropriate?
Well, I would say that there are 3 sessions in this presentation. So after each session, once I'm going to end this first session, I'm going to take questions, and after second and third, I'm going to take more questions.
Fantastic.
So let me end this first section, and then I'll take the questions, because
I like the plan. That's a good plan.
Right. Okay. So what is this cost accounting? The cost accounting is basically also cost management accounting, because this is it's been specifically devised for the management to help them make decisions where the costs are occurring, and how and where they are losing the money, and how many idle hours of labor happen during the year. Like for example, the machine broke down and the repair work had to be carried out, and it took, say, about 10 days, and the labor had to be paid because they were there for the at the scheduled time, so they had to be paid. But the machine was in a state of disrepair. So that's what the company, and that's what the management, that's what is the purpose of the management accountant is to see the information about the costs. And this cost accounting, or the management accounting, is typically I emphasize, I underscore, is typically used in the manufacturing industry, where you have to focus on the cost cuttings, cost controlling, and optimum product mix. And for example, you're buying from you manufacture. For example, your product is goes through 3 processes. For example, A, B, C. And your product, and then your final product is D. You say, okay, A is okay, we are manufacturing it. Then we move to the B. Then you have to just realize that your cost is too high for manufacturing B. So what will it be a good idea to outsource it? Will it rather than manufacturing it, or any of the ingredients, things like that. Whether you can outsource it, or whether it will be a good idea to continue with the in-house production. So these are such areas, core activities of manufacturing, where you have to talk about, and you have to be fixated upon the cost controlling. Can we move to the next slide? So these are the differences in a tabular format. That's what you can study, and that what is how they are different from each other, how financial accounting is different from the management accounting. When it comes to the regulations in the United States, it's typically they're being governed by the generally accepted accounting principles, which is called GAAP, and I would say 90% of the world they follow the standards of International Accounting Standard Boards, IASB. They issue the standards which are referred to as International Financial Reporting Standards, IFRS 1, IFRS 2, IFRS 3. They've got a huge book in UK and in Europe, in Asia. They follow the standards, but they're basically primarily related to the 4 statements that I told you that I talked to you about at the beginning. The financial statements, the management accounting, like I told you before, it's less formal. There are no standards for it. You can tailor it according to your needs, and how to reduce your cost when it comes to the timeliness. Obviously, by the end of the year, obviously 31st of December usually is if it's the year end of a company, then they have to prepare every year report. But when it comes to for example, if they have to for the cost controlling purpose, if they have to prepare a variance report or a budgetary report, things like that, they can do it any time of the year. And the level of details, obviously, these statements have to, when it comes to the financial accounting, all these financial statements have to be in accordance with the regulations, and they have to meet and they have to comply with the requirements. Whereas in management accounting or in the cost accounting, there are no fixed requirements. You can modify it according to your needs. And the main users of financial accounting are the ones who are more interested, for like suppliers, consumers, employees, banks, taxation authorities. They are the internal and external users. They would like to know about the financial information. And when it comes to the cost information, how much is the expenditure of the company during the fiscal year? It's basically they are either the owners or owners or managers, especially production managers in a manufacturing company. They like to know more about the cost accounting. So the cost accounting is that's how we differentiate this cost accounting from the financial accounting, because management accounting or the cost accounting purely focuses on costs and profit margins. Can we move to the next slide, please? Okay, so here it's at the end of the section 1. In the section 1, we talked about the accounting process, how this accounting process is basically covered 4 key areas. First of all, you identify the business transaction, then you reliably measure and record it, and then the third process was communicating that information in the shape of financial statements. No, yeah, no, back you. So just recapitulating, I told you the accounting information, whether it comes from the financial accounting or the management accounting. The users can be external users, they can be or internal users. I've told you who can be the potential internal users who would like to read the accounting information, financial accounting, because obviously when it comes to the cost, when I'm talking about the cost accounting, obviously taxation or the consumers, obviously they would be interested in finding out that how much profit the company has earned during the current year, but they would not be interested, obviously, in the company's internal budgets or optimal the production mates or any budgetary or variance reports, things like that, where they're trying to keep the cost under control. So that, I mean, that's how we differentiate and make a distinction between these two branches of accounting. And that's it. And now this is the end of the section 1, in which we have in which we have briefly talked about the accounting process and the two main branches of accounting, financial accounting and management or cost accounting. Now, if you've got any questions, please feel free to ask.
Thank you very much, Dr. Waqas. This has been a really outstanding presentation that was very rich of all the types of details that we might need on the topic of the accounting process. Like Dr. Abrar has mentioned, this is just the first of a series of 3 classes that he will be presenting live on this topic. We started a little late, so we're not gonna linger any longer about what he has said. There was mention on the chat line about your ability, you the participants, to download either this one or previous class sessions. So if there is anything important that you've missed, you can grab the full content of Dr. Waqas Abrar's presentation on this topic of the accounting process. But let's go to a few questions. The first one with Herbert Subuga, who is raising hand at this time for a question. The floor is yours, Herbert.
Okay, thank you so much. I appreciate for the presentation, and Dr. It has been so wonderful. Because of poor network, I missed some of the items during his presentation. So my question is it possible to get it from my personal portal? Thank you.
Yes, before Professor Dr. Waqas responds, this is something that we've been saying all over in the chat line, and also I'm repeating right now that yes, this recording and all previous recordings are downloadable, which means you can download the content, the entire content of this presentation. As a matter of fact, there is another mention that Dr. Gonzalez also made. There is an email that will be sent to you, to all the participants, including to you, Herbert Subuga,
yes,
about your ability to, number 1, download the content of this presentation. Number 2, get a certificate of presentation, which is very important. You can show that to whoever you choose. And number 3, to also earn a credit, an academic credit, based upon your successful response to a little test that will be posted about this presentation. So very soon you're gonna have all that, and I hope you will be happy about the whole thing. Thank you for your question, Herbert. And we are now.
Thank you.
Very welcome. We're moving to Moji Sola Esther. I know you've asked some questions on the chat line, but now it's your turn to ask the question live to our presenter. Go ahead, Esther.
Thank you very much. Thank you, Prof. Okay, so I have some questions on the chat box. I would love those questions to be answered. And apart from that, I have another question. Prof was talking and he said cost accounting is only used for manufacturing businesses. And I'm asking why so? Why so? Because other businesses also have cost elements, and a lot of time we have in my own company we have management reports every week where we review our activities for the week, and we ask the CFO or the C-suite, we ask questions, why is this so? And where costs are high, we call in the heads of department to ask, why is this cost this way? But when you are now saying that it's just for manufacturing, and I'm like, so what of other sectors, other industries where costs are also part of their businesses?
Okay, thank you, Esther, for your good question. I said when it comes to the management of the cost accounting, it's primarily used in the manufacturing industry with a heavy focus. And there are always two kinds of sector, manufacturing industry sector or the service sector. When it comes to the service sector, yes, that's true. They also do prepare the management accounting reports or the cost accounting reports every week, every month, in order to know, in order to get acquainted, in order to let themselves know that where they're spending so much money, and is it worth it? If they're spending any money on the advertising, and then they see the fruit of it and the time, through the advertisement on the digital platforms. For example, last week, if they spent $500, how much did the positive clients, paid up for the services that were being advertised. So this is not. I did not mean to say that this is only used in the manufacturing industry.
Okay.
I just wanted to say that it's the more heavy use or primary use or predominant use is in the manufacturing industry, because they are more concerned about the cost. Because if the price, for example, if the price of a water bottle, say, is $5, they would like to know that how much, for example, and the cost of manufacturing is $3, and they're earning a profit of $2 per bottle. They like to know how much more they can reduce, and this is called economies of scale, which is an advanced topic and debate. But this is something that the manufacturing industry is always is always in the hunt, is always they're trying to read and as much information as possible, and they're always trying to find out the ways how they can reduce the cost and in order to get the optimal product mix. But it's also used in the service industry, real estate, in the agriculture industry, in all industries. But the users of the cost accounting are usually the internal users, the management, the managers, because obviously the taxation authorities, the consumers, they will not be interested how much was your budget, how much was a variance report, what was your plan of action, how did you manage to reduce the cost, things like that. Obviously it's basically for the internal purposes, to improve the cost and to enhance and to increase the profit margin.
Thank you.
Very much, Professor Waqas. We are now.
Please, what of other questions that I asked, sir?
Go ahead, Esther.
Yes, they are in the chat box. I
Yes,
went off for a while, so I couldn't get those questions back.
Can you recall them?
I have them here.
Okay.
Okay, I'm reading the two other questions that Esther has in the chat line. Number one, she asked, how are the taxes of both entities treated by law? And also she's asking, why is leasehold not treated as asset? Okay, right, okay. Yes, how are the taxes of both entities treated by the law? They're not entities, they're both different two branches of accounting, not entities. First is the financial accounting and the second one is cost accounting. And obviously the tax authority would like to know how much
the profit the company has earned during the reporting year, for example, 2022, from 1st of January to 31st of December 2022, how much was the revenue, how much was the cost, and how much was the net profit. And if the rate of tax is, say, 20%, and have they paid 20% or not, right? And when it comes to the second thing, the cost accounting, you can purely see it's for the internal purposes, that it's basically for even for the owners of the business, for the management, for the managers, production managers. They would like to know that, you know, whether it's better to make this product A, B, C, D that they have to use in the process of manufacturing or developing another product, or whether it will be a good idea to outsource it, to get it from another supplier at a much cheaper cost, let's say from China. If you're manufacturing it in America, which is costing you too much, you calculate the cost and you come to the conclusion that it will be much more cheaper if we get this directly from the China rather than manufacturing it here, because it's costing more. That's why it's basically the cost accounting is only for the management, or for the managers, to help them understand about how much cost they are incurring and how they can reduce it. And they obviously they make budgets, and obviously they are not supposed, they're not bound by any law to present that budget to the regulatory authorities that this is our sales budget or the marketing budget. Obviously it's basically only for the internal purposes. So that's why the management accounting is not subject to any taxation. And why is leasehold not treated as I said? Yes, very good question. Like I gave you the example of Enron back in 2000. They, for example, if you buy a house, you know, in the first few slides I gave you the example. As of today, the cost of the house is, say, 100,000, and 40,000 you have paid, and 60,000 you owe to the bank. Okay, so how much is your ownership in how much is your ownership in the house as of today, or as of 31st of December 2022, when you're preparing the financial statements? Your ownership is 40%. That means you own $40,000 in the house. You do not own entire 100,000. That was the case before. That what Enron did, if they bought any assets on lease, they, you know, capitalized it. They, you know, in the classic accounting equation where I told you that assets are always equal to liabilities plus equity. So that's why when I gave you the example of your house, which you which is on mortgage, and you're preparing your financial statement for the year ended 2022, from the 1st of January to 31st of December 2022. So how much would you report your leased asset as of 31st of December in the financial statement? You would say that my asset of the asset is 40,000, and 60,000 will be reported as a liability. So it will be treated, the leasehold, you know, the lease asset will be treated as an asset, you know, according to the amount, according to the payment that has been made. And let's say if next year you make another payment of 10,000, and your ownership in the house increases from 40,000 to 50,000. And now you're going to write in your assets box 50,000, and in your liabilities 50,000, and that's how your liabilities will reduce. And your once after 4 or 5 years, you will own that house fully, and you'll report that a house fully at 100,000. and there will be a no liability. And that's how that was the purpose of introducing the IFRS 18 International Financial Reporting Standard on leased assets by the International Accounting Standards Body after the financial collapse of Enron in 2000, and where people lost their savings, their entire life savings. It was a big company, and it was a huge loss to people, and that's where the SEC, the Securities and Exchange Commission of United States, came into action, and they introduced this law.
Thank you very much for your response, Prof. Abrar. I know Dawo Victorine, you've been waiting for a little while. We are now with you for your question or comment. Victorine. Are you with us, Dawo?
Victorine, you've got a question, please. You can ask now, please.
We apparently are losing Victorine. The next hand up on my list is Olanwe Wahu or Badaye. We are waiting for your question, Badaye. Badaye is also a part. Go ahead.
Ilunga, you've raised your hand. You can ask a question if you have got any.
We just have to ask them to unmute, because I don't think they're able to unmute themselves.
Yes.
So if we call on someone, we just have to click on ask to unmute.
Yeah, Lambai is ready right now.
Okay.
Go ahead, Lambai.
No, he's unmuted, but his audio is not connected. Looking at the time, since you have a couple of additional sections,
yes,
I'll read a comment from Akasio Edu. He said, "Good evening. Please, the process to design the databases for internal and external information, it could be important to identify the flow of incomes and expenses to the entity to avoid losing real economic information that permits economic growth. And my question, is it crucial to identify the risks firstly and add alphanumeric accounts?" So Akasio, I don't know if I asked that correctly or if you'd like to clarify something.
No, I didn't get it. I didn't get the question. Was it asked by you, Ricardo?
It was asked by Akasio Edu. I just unmuted. I asked you to unmute. So if you care to clarify a little bit, that would be great.
Who?
Go ahead, Akasio.
Which participant?
Okay, please. Good evening. Yes, my single preoccupation is when you use the commons account, for example, in Africa, you maintain the other system, but what could be the risk when for example, in our entity, you could any intruder, we call it intruder. Intruder is person who might not have access to our database. That means, for example, if somebody with the bad thinking enter in our database, it can manipulate the information and send any data that might not be manipulated.
Yes, okay. I got your question. I've read it.
Okay.
I've read it. I've read it in the chat. Okay. Yes, for this purpose, to develop the databases, we've got sophisticated ERPs nowadays, which we call Enterprise Resource Management Systems, ERPs. You must have heard the names such as Oracle and SAP, Microsoft Dynamics 365. These are enterprises, and they have got a module on finance, and in that module they've got databases both for the cost accounting and also for the financial accounting, and obviously there would not be any there would not be any there would not be any loss of information if they will be recorded appropriately. But when it comes to the big companies, obviously, because these softwares are pretty expensive, and what they do is, big companies, I'm talking about big enterprises, their databases are connected in real time with the tax authorities. So the tax authorities would come to know, would obviously know that in the first month of 2023, how much the company has earned, how much the company, what was the revenue and what was the net profit. So they're connected in real time. But for the small companies, which are called small and medium-sized enterprises, SMEs, these softwares are pretty expensive. They use some off-the-shelf or some very economical softwares, which you can buy easily from the market, at nominal price, such as QuickBooks. These kind of softwares you can buy for your accounting, and with the help of that, you can develop a database both for the financial information and for the management, both for the financial accounting and also for the cost accounting or management accounting, and there would not be any losing real financial information. That would hinder any economic growth prospect. Now, it would not, but it depends on the company, what the company would like to do with whether they're maintaining any computerized softwares or not. If they are not using it, then obviously there is a chance that they are in the process of they're in the process of doing some tax evasion, which is hiding or concealing the total net profit in order to pay less tax. Things like that happen, everywhere. But when it comes to the big companies, they've got sophisticated online enterprise resource planning systems, ERPs, SAP, and Oracle Financial, very sophisticated and very highly technical softwares, and basically they're run by chartered accountants who extreme, highly qualified chartered finance professionals.
Thank you very much, Professor Abrar. We are very, very happy with all that huge web of details about the topic of the accounting process. We are also happy to know and to also remind our participant that this was just the first of a series of 3 presentations by Dr. Waqas Abrar on this topic, which means, number one, if you miss any single element of this presentation, that's going to be on that link that Atlantic International University will be sending to every participant. You will have plenty of opportunities to review all the details of that presentation. Number two, Dr. Waqas has very precisely indicated that he will be back for 2 more presentations on this topic, which also implies that if you, the participants, have additional questions, you certainly will have more occasions to bring up those questions. With that note, we want to put an end to this wonderful presentation by Dr. Waqas Abrar.
Excuse me, sorry to interrupt. I believe Professor Waqas has split today's presentation into 3 parts.
That's what I just said.
Okay. Okay.
Yes.
Okay.
I
Okay. Okay.
just mentioned that the participants will certainly have plenty of opportunities to ask other questions, because this is just the first of a series of 3 presentations on this topic.
Okay, let me just clarify. Yes. No, what I wanted to say is that the 3 parts are in today's presentation.
Okay.
Yeah.
Yes.
Yes, yes. Today's presentation. So we have concluded our first section, and now we're moving to the next session, which is about globalization and how the globalization has affected, or what is the impact of globalization on the accounting processes.
Okay. In the meantime, let me also interject something real quick. I am very, very sorry to apologize to both yourself, Dr. Waqas Abrar, and to the participants as well, as wasn't aware of that there were going to be other sections of the same presentation just today, and I have some other commitments that I have to honor. And I'm so sorry to inform that I'm going to be leaving, but of course I will get that presentation online, and I'll be certainly very joyful, very happy to see those details about your presentation. I am very, very happy. I consider myself a blessed person for having heard this presentation. Thank you very much, Dr. Abrar. And to all the participants, I wish you the very best. Thank you very much.
Thank you. Thank you very much. Thank you very much, Dr. Wilson. Thank you. Okay, let's resume. After the resumption, let's resume, guys. Okay, so I just wanted to, let you know what is the effect of globalization on the accounting, how this globalization has affected. We say it very, it's buzz sentence that nowadays the entire world is a global village. We live in a global village because the people are so much connected. The companies are doing so much business here and there in 2 countries, in 2 continents. So the companies are becoming larger. For example, Nestle is just one organization. They've got operations in so many countries. Procter and Gamble is another name. They've got operations in so many companies. Honda, automotive, they're making the cars in so many countries. So these are the called multinational companies, and and that's what that's what the globalization is all about. That they're expanding in the other territories, which is actually making the accounting more, and audit services, they're making it more complex. How? Because if the Honda Motors or the Kia Motors in United States is paying the tax at the rate of, say, 25%, maybe in Germany they're paying the rate at the rate of the tax at the rate of 15%. So that's how and there will be some the auditing standards which are being followed in Germany would be different from what's being followed in the United States. I do remember it was about at the beginning of 21st century in 2002 or 3, I think, when I read many stories that all the big manufacturing companies from the United States, they moved their manufacturing plants from United States to China. Why did they do that? Okay, so because of certain benefits, because for the first 3 years they were not supposed to pay any tax, and the electricity or the energy costs were much lower what they were paying in the United States. Third, the cost of the labor was much lower what they were paying in the United States. So keeping in view several advantages, I remember HP computers, Dell computers, Microsoft, they, shifted all their manufacturing plants from the United States to China. Why did they do that? I told you the advantages of cheap manufacturing. And the same was followed by the Apple iPhone. They started manufacturing iPhones in China because the cost, because of the cost factor, the cost on each cell phone was much cheaper, while manufacturing in China as compared to United States. When came the President Donald Trump, he say that we are losing the jobs. So it's better that all the manufacturing companies who have got the headquarters, who are originally from the United States, such as HP, Dell, these tech companies, or Samsung, or Apple, iPhone. I mean, they must start their manufacturing plants once again in the United States. It will, because, and then the iPhone they were selling at the rate of I think it was iPhone 10 or 11, I don't remember, but what they were manufacturing by that time, about 6-7 years ago, at the cost on each cell phone was $500. But when they moved their manufacturing plant to United States, on each cell phone, they had to incur the cost of around $1,200, and the cost and the price for the customers, it went up like a rocket. It skyrocketed. Why? Because they moved from China. They moved their manufacturing plant from China to United States to cost due to the cost controlling factors. And all the big companies, I give you the example of JP Morgan Chase, which is arguably the largest, the biggest bank of United States. In the 2010, their profit was 17 billion. Their assets was nearly around 2100 billion. And in the last 12 years, this profit has doubled from 17 to 35.89, and the assets have increased massively too, now 3665.74 billion. And because the people in the JP Morgan people are investing from all over the world. If you believe that people only in the United States who are living in the United States are investing in the JP Morgan, no, people from the UK, people from China, people from many European countries, I mean, you can do this online trading nowadays. It's very easy. You can buy shares and you can make a profit. You can get the dividends every year. Along with, you can also get the capital gain if the company is doing well. And that's why, because of this globalized structure of the big companies, because the multinational companies, because of the impact this globalization has, the accounting processes have become more diversified, across different countries. Like I told you before, the accounting process in China was different. Tax rules were different. There were no strict laws about the environment and things like that. You can use the fossil fuels, but if you move to the European countries, you have to be very careful. There will be, you're going to find some very stringent rules on the environment if you're going to do any environmental damage, if your manufacturing company is doing any environmental damage. So that's what, the accounting has become a little bit more complicated. So can we move to the next slide, please, Ricardo? Yes, this digital disruption is very important. The digital disruption is, sorry, the digital disruption is basically referred to the new technological advancements and the new business models digital transformation which is happening everywhere in the industries and in all the business sectors. It's a change which can be positive or negative, but obviously it is the need of the current time, and it's very important. And how this digital disruption is making an impact. For example, we start with the emergence of fintech industry. For example, now the banks who do not offer any online services, for example, if I have to pay my utility bills, I remember that about 10, 15 years ago, I physically, had to go to the banks and pay my bills, pay my utility bills, every month. But now I'm paying my bills simply on a mobile application, which is being provided by my bank. So it has become, you can say, an indispensable for every bank, to digitalize their operations. Nowadays you can see so many, if you go to the Google Play Store, you can find lots of applications offering digital loans, which actually were very hard for the small companies or for the people who had no bank accounts in previous years, such as farmers, etc. Now they can easily get the loans from these small digital tech companies, and that's where they have really make a big impact on the accounting process. Now the data being produced is also making a big impact. I was reading in an article that about 90% of the total data that we have got today, 90% of it was produced in the last 2 years. So we've got so much data being produced, and in different sectors, and it is making a huge impact on it. And same goes to the cloud computing, mobile phone technologies, and artificial intelligence. Probably, it's the artificial intelligence will replace plenty of accountants in the next few years, or probably in the next decade, in the next 10 or 15 years. The humans will be replaced by machines. And the next is the blockchain technology, which is a very interesting technology about the cryptocurrencies you must have heard about, such as Bitcoin, and these payments do not have to go through financial institutions. These are cryptocurrencies. They are invisible, but obviously it represents a financial ledger, a proper financial ledger, which is cryptic, and which is partitioned or managed into different technical blocks in a computer, and this obviously has eliminated the need of many accountants, many bankers, and that's where the human jobs will be lost. It's prediction by some of the top consulting companies that this blockchain technology, people paying through bitcoins, and the currencies will be replaced by these cryptocurrencies. And that's how I summarize this section by stating, can you move to the next slide, Ricardo, please? I was summarizing this. Yes, like I told you before at the beginning, that how this globalization, the businesses have expanded into different countries, different laws in different countries, different accounting processes, environmental laws, and the other types of laws which they have to comply with for setting up a business. For example, for setting up a company is different in different territories. So that's why the globalization has made a profound impact on the accounting processes in different countries. And the second part of the digital disruption was the digital transformation. I talked to you about that the way these digital transformation is changing everything, For example, now the people are advertising on the digital platforms such as Facebook or Twitter or YouTube. It wasn't that before, and that's what, you know, and that's why the accounting has changed due to these digital due to this you know, this digital transformation, and especially the financial technologies which are involved. And now they are compelling the traditional banks to follow the financial technologies. And if you have a bank account in a bank that does not offer any digital service, any mobile application, or any online account that you can access from your home, obviously you would not be keeping that account anymore. And obviously you would switch to a digital account when you can make the payments, such as for the Amazon, for the Netflix, for the eBay. For so many for companies, you have to make online payments, and the banks who are not who cannot, you know, fulfill your request for the online payments, obviously you're gonna change your account straight away, and you would not be you know, retaining that account anymore, because obviously the customers' expectations have changed due to this digital transformation. Now, I conclude my second section. Ricardo, if someone has a question, why don't I finish up the third session and then take the questions, Ricardo?
Yes, please go ahead. Thank you, Professor.
Okay, business sustainability. Business sustainability is a little tough one. It's a tough one in a sense, because it'll be hard to grasp if you are aware of this sustainability issues. If you are, very good. If you're not, then it might be a little bit difficult for you to find the association between the sustainability factors and the accounting process. Now, the business sustainability is referred to the world's resources that do not compromise the ability of future generations to meet their needs. For example, the entities now have to be very careful about all the resources that you're using. The labor, they have to be very careful about the labor laws, occupational health and safety. Obviously, these laws are nowadays everywhere. In UK, I do remember people, if you get an unfair dismissal, you can file a claim against your company's owners, and if they have wrongfully dismissed you, I mean, you can win a case against them. Same goes to the energy. Now the people are moving to the renewable energy, and we have got this global target of achieving zero net carbon emissions by 2050. And we have to get rid of the fossil fuels in order to make sure that you know, the climate change, which is a very hot topic nowadays, you know, this climate change, so that we can tackle these natural catastrophes like storms, like earthquakes. Recently, we saw the very horrific catastrophe in the shape of earthquake in Turkey and Syria. It was horrifying, and this is all happening because of this unprecedented change in the climate settings. Forests are depleting. Same goes for the water resources. Air is getting polluted. You know, and that's where more and more stringent laws are coming for the companies. You know, to make sure that they comply with the environmental standards, they comply with these social standards, and all the outputs. For example, in the automotive sector, by 2030, the diesel-powered vehicles will be stopped. You know, there will be hybrid cars. You know, that will be run on petrol, as well as will be run by electrification. And by 2040, it was signed in the Paris Agreement, in the famous Paris Agreement in 2016 or 15, I reckon. So in the COP summit that was held in Paris, that by 2040, no automotive company will be allowed to produce a gasoline, any vehicle that will be run on gasoline. They will be they will have to start producing the electric cars, and the future belongs to the electric cars, autonomous cars, connected cars. That will be connected through the internet, and that will be autonomous. Driverless cars. But the most important thing is, when it comes to sustainability, it comes to is getting rid of fossil fuels to make sure that we can handle this this very unprecedented change in the climate. Next slide, please. Okay, so what are the key drivers of the sustainability? I've briefly explained the first two things, that the world population is obviously growing. It's nowadays, I think it's 12 or 13 billion. The population is. A decade ago, it was 7 or 8 billion. We have seen an increase of 4 to 5 billion in the past decade. So it's a burgeoning and it's a very alarming, and the clock is ticking. It's high time that we should start preparing ourselves to save the resources. And same goes to the climate change. Like I told you before, from the fossil fuel based economy, we have to move to the renewable energy resources such as solar energy, and the hydropower energy produced through water and other renewable resources, in order to make sure that we get rid of the fossil fuels, especially the coal. About 80% now, as of this moment, as of the stats that I know, that China is very much dependent on its energy being produced from coal, and the coal is producing lots of carbon emissions and other gases, which is decontaminating and contributing profoundly to the environmental pollution. And then there's economic globalization. Like during the COVID-19, we saw that due to the supply chain issues, we saw shortages of different commodities, even vaccines, other medical supplies, etc. So this has a profound impact on the accounting and the financial information as well. And the next thing is the connectivity and communication. I think 20 years ago, 2 decades ago, we never thought that we would be talking to each other on a Zoom meeting. Delivering a lecture on Zoom to the university, to the university students, because there was no concept of giving online lectures about 2. And now Facebook is seeing an increase of millions and millions of users being following, signing up. Twitter at the moment has got 7 million users. So in the last 2 years, they noted and they reported a 1,000% increase in their total number of users. Sorry. So this international connection, communication has rapidly increased, which is a fact, which is obviously making a profound impact on the key drivers of business sustainability. Next slide, please. Okay, these are the business sustainability, the drivers that I talked to you about, or the key principles. Very much you can follow, you can read it. that we have to basically comply with the international standards related to ethics, governance, transparency, business relationship, financial return, and also in the community involvement, and employment practices. Now, there is an increased oversight of, that you have to have some very good human resource management practices. Otherwise, the authorities won't spare you. Occupational health and safety laws, are being strictly followed. I think it wasn't this case, 20, 30 years ago. And also now in the advanced economies, I would say, in the United States, in the Western countries, also in the Europe, now there is an increased demand that if, about the environmental protection, and whatever the product or processes or services that you're delivering, you must not do any harm to the environment. And these principles or the laws are becoming more and more stringent in the years. Now, these three theories are very important when it comes to business sustainability. A corporate social responsibility is the responsibility of an entity or an organization to all the stakeholders. All the stakeholders means to the consumers, to the suppliers, to, they have to maintain some good ethical practices at the workplace, with the employees, with the regulatory authorities. The corporate social responsibility means that they have to obviously work on the corporate agenda to make for the financial gains, but they also have to be aware of the social responsibility that they have to contribute to the planet as well. And that's what we will talk about later. The shareholder value suggests that shareholder, or the owners basically who invest in the companies, should be the primary focus of the organizations. This shareholder, or the shareholder theory says that the prime focus, or the main responsibility of the management of any company should be to make as much profit as possible. Ignoring all the ethics and environmental standards and social social distribution, things like that, and which basically is an outdated one. And now the stakeholder theory is a newer version, which basically suggests that the purpose of the organization is just not to work. It's just not to work for the owners. Owners are the shareholders who are effectively the owners, because they have invested the money in the company, and that's how the company is being run. They are the owners, and the board of directors should be working tirelessly, painstakingly for them only, which is not true now. And it's which says, now the stakeholder theory says that you have to work for all the other people as well, for the other stakeholders, and that's how you maximize the shareholder wealth as well. For example, if I come to know today that on Coca-Cola, if the price of Coca-Cola bottle is, say, $15, for each $15, $1 will be $1 the Coca-Cola company will be paying to the victims of earthquake in Turkey and Syria. If I'll come to know about this on television or social media ad, if I see this, that if I'm going to go down there and if I'm going to buy a bottle of Coca-Cola, $1 will be spent on the charitable purposes. So what I'll do is that I'll think for a second, and I'll say, no, I won't take Pepsi. I won't take any other soda drink. I'll take Coca-Cola, because the price is the same, but the Coca-Cola is working for a more charitable purpose. they are donating their $1 profit to the earthquake victims. So this is that's how more people will be enticed or persuaded to buy the Coca-Cola drinks, and that's how their profit will be substantially increased, and that will increase the wealth maximization of the shareholders as well. So the shareholders will get the benefit at the end of the day if the company will behave, or if the company will operate in a sustainable way. Next slide. Ricardo, next slide, please. Okay, stewardship theory is the same that I've talked to you about. Is very much similar to the stakeholder theory, that the directors or the board of directors should act in the interest of the stakeholders and not just the shareholders' value. If they're gonna start talking about this thing that we just, the real owners of the company are the shareholders, and we should focus on making as much profit as possible. And and we should work on the wealth maximization of the shareholders only, and we should not think about the planet. We should not think about what's happening around. And if you're not going to participate, in the social activities, in the charitable causes, so that will actually really hurt the profit, the wealth maximization of shareholders at the end of the day. So stewardship is basically encourages the directors to act in a responsible, ethical, and empathetic and sustainable manner. The legitimacy theory suggests that the entities must conduct operations in accordance with the societal expectations. For example, if I live in a community, and if I come to learn that there is a new chemical plant being opened in my area, contributing a lot of carbon emissions and other dangerous gas emissions. If I see that, and if I report to the authorities, obviously nowadays the environmental laws have become so strict that they'll shut down the factory. So this theory suggests the legitimacy that your business must be legitimate. It should act in a responsible way in accordance with the expectations of the society. I do not want any factory giving the damage to my green society. Next. Okay, this was a summary of the third section, where we talked about the business sustainability, when we have to be very careful about the way we are depleting the world's resources, and our future generations will be in danger. So we have to be very careful about preserving the forest. We have to be very careful that we take care of we get rid of fossil fuels as soon as possible, to stop the hazardous effects and to prevent the hazardous effect of climate change. And the 9 principles of business sustainability performance we talked about, where they can contribute. These are the standard principles that every business has to comply with, and the responsibility of the business has to be, every business has to be socially responsible, and is assessed and examined through a number of theories. And the theories we have talked about, the legitimacy theory, stewardship theory, stakeholder theory. This stewardship theory is basically that nowadays that the board of directors, the attitude has changed. I give you the example of Coca-Cola. If I tomorrow read something in the newspaper about the Nestle, that the Nestle, paid scholarship to 25 students, 25 Nigerian students, full funded scholarships to study. And if they make this announcement in the newspaper or in a social media website, I'll be impressed. And next time, if I will go to the to a grocery store or to a supermarket, I look at the juice or the other products of Nestle with much respect, and I'll say, yes, this, although this company is making lots of profit, but they're doing some charitable, they're doing some charitable things. They're involved in some charitable projects. So what I should do is that I should do something. I should buy some products of Nestle. Just it'll give me a kind of inner satisfaction that I have contributed in some way. I think this is the end of the section 3. Now, if you've got any questions, please feel free to ask.
Fantastic. Thank you so much, Dr. Abrar. It was a great 3 parts. Your parts 2 and 3 weren't quite as long as the first one. The first one was, I guess, the larger section. And I'm glad to say that we have still pretty much the same number of participants as we began. I think we started with 54, 55, and we're at 49 participants. So most of the students are still here. And let me see if I see some questions. Let's see. Let's start with Lumbayi Ilunga. You've had your hand up from before. I don't know if your audio is working now. Lumbayi, I see you. Oh, fantastic.
Yes, Lumbayi,
Yes, I see you. Go ahead.
I think there's some problem with the audio.
Lumbayi, I heard you, I think, for a split second.
Can you hear me now?
Yes.
Yes, we can hear you now, Lumbayi.
Oh, okay. I just wanted to know about 3 things. The first session that you gave us. So the things that I wanted to know better, it's management accounting, financial accounting, and cost accounting. They are all important, or one is better than other?
Okay, so I think both are beneficial. One is mandatory, which you actually must complete, which is financial accounting, because there is a lot of expectations, because the tax authorities tomorrow are going to knock at your door and will ask that how much you've earned, where is your paperwork, how have you digitalized or recorded all the accounting transactions. If you have, okay, have you got them audited or not? They'll ask different sort of questions, and you say that yes, I got a net profit of $10,000 in the year 2022. My company has made this profit, and I have according to the laws, according to the tax law of 20%, I have paid $2,000 tax to the authorities. I've submitted it online or whatever the process was, and this is the receipt. You can show the documents. And if you've got a very big, if you're working in a very big company, then obviously there's some very sophisticated and very complicated matters, and that's where they hire special taxation managers or tax consultants, where they can because there are some expenditures which are tax exempted, and there are some which are not tax exempted. For example, if you donate to a charity, if you for example, if you get a money from some money from your brother, say $10,000, which is subject to the national or the domestic tax law, but you got that money of $1,000 from your brother, but that money was paid. You sign an affidavit, and that money you you paid to a charity, or, looking after the orphan children, then you can apply for the tax exemption. That on the $1,000 that I received from my brother, although it is subject to taxation, but I spent it on, I donated that money to a charitable organization to, looking after the welfare and well-being of orphan children. So that will be, that amount will be exempted from your total income. So that's how this taxation system works. So this is the financial accounting. When it comes to the cost controlling or the management accounting, which is really up to you. You're making the budgets, and then after you make an advertising budget for your company if you're working, and and you see that, okay, yes, after a 3-month budget, and after once the 3 months have elapsed, then you start making a variance report, or that what was your budget, how much did you spend, what was the outcome. Then you make that sort of comparative kind of analytical report, and that's basically up to you whether you want to make it or not. People want to make it. Managers and managers and owners, they are interested to know that how much cost we are incurring, how much is the cost associated with each product. And especially, like I told you before, this is more applicable or heavily used in the manufacturing industry, though also it's used in the service industry. But the importance or the significance of cost accounting is pretty much high in the manufacturing industry, where they're always want to know. Obviously, if you, for example, if you are selling a bottle of juice for $3, but your cost of manufacturing is $5, obviously you can't sell that bottle of juice at $3 if your cost of manufacturing is $5. You would obviously want to reduce your cost of manufacturing from $5 to say $1 or $2 or $2.5 to make sure and just try and make sure that you cut down your cost, that you cut down your cost of manufacturing as much as possible.
Fantastic. Thank you very much. Yes, I would just add, if you're an investor, if you're analyzing companies from the outside, the financial accounting might be the most useful to you. Steve, you haven't had a chance to participate. I saw your hand up. I don't know if your question was answered because you put your hand down.
Sorry, Steve, can't hear you.
Oh, there we go.
More detail.
Yes, I hear you now.
Thank you so much for the answer.
Oh, okay. So
Thank you, Lubai.
Dr. Abrar, I love your session today. It has enlightened me a lot more than what I know about the world environment. However, my question is a little off topic, because if there's a company setting up
Sorry,
Steve,
I've lost your voice.
We heard the part about if there's a company setting up, and then it cut off. If you can type it in the chat and I'll read it, I'll be happy to read it out loud, Steve. Let me go to Obafemi Keishi, since you had not had a chance to participate before. Obafemi.
Yes, Obafemi, you can ask. We've seen your hand being raised. You want to ask a question, please?
Let me go to
Unmute.
Rosie. Rosie Praise TV. Okay.
Hello.
Hello.
Yes, hi Rosie, we can hear you.
Yes, I don't want to do the video because of where I am, but I hope you can
No
hear me.
problem. Yeah, that's fine. That's
All
fine.
right. All right. So my question, well, I found this particular live video very interesting. Thank you so much, the presenter. I'm not an accounting student, but this particular presentation has helped me. My question is this: judging by what following the explanation, the last explanation of what the presenter just talked about, cost of production. I was just thinking, well, sometimes in cost of production, maybe you want to meet up with the quality, or you want to provide a quality, service. Now, I think the cost of production would determine the quality of the service you're going to provide. Am I right, sir? Like when you sometimes, for example, you may use, like, your analysis, you may use like $5 to in total of your production, and then probably out there in the market you cannot sell that particular product for like a $7 or an $8 or a $6, and people are pricing it down. And then you, who is the manufacturer, like, wow, you're putting in so much. And of course, the objective of every producer is to make, again, to move on to the next level, right? So sometimes when we want to cut down production, don't you think it might affect the quality of the services we're giving? Because that particular manufacturer will, of course, want to do everything to bring down the quality, the expensive or the production, thereby, the quality might, become, less qualitative. I don't know if
Yes, I got the gist of this question of yours, Rosie. Thank you. Yes, it's if I'm if I'm making a product, for example, if I am that's again, we can take the example of I was just taking the sips of a juice bottle. If I am making this juice bottle at the cost of like $5 per per bottle, if my cost of manufacturing is, I get my accountants and I get my accountants around, and I tell them that, okay, we've got like a batch of like 1,500 bottles. Tell me the price of each bottle. Tell me the cost of each bottle, the cost of production behind each bottle. And they go to the production managers, and they go to the raw materials manager in the supply chain, and etc. My accounting team, they complete the process. If I'm the owner, they will come up to me and say, the cost of production behind each bottle is $5, and now it's up to me to decide what should be the selling rate, so 7 or 8. Okay, when I ask my sales team, okay, hi sales team, sales and marketing team, how about setting the price at $7 or $8 for each bottle, and they would say, come on, there are so many brands already existing in the market, and the maximum cost for 1 liter juice bottle is $4 or $4.5. And I will say, no, how, why my cost of production is so much? Then I will have only 2 options. Either I would try to reduce the cost from $5 to say $3 or $3.5, and would try to sell it at $4 or $4.5, right? To make sure that I get some profit. Or I'll try to lower the quality, like you said, that I will have options. If I reduced or if I compromised on the quality of production, then obviously I'll get bad reviews. maybe, you know, my market capitalization or the market share of my product will be reduced if I drop the quality. People do that. People do try different sort of other strategies, like, you know, if, you know, if my juice bottle is comprised of like five sub products, like 1, 2, 3, 4, 5, go through the 5 processes. You know, what about, you know, outsourcing, you know, 1 or 2 process? You know, then, you know, I'll make all the cost calculation, etc. If I can reduce the cost, then I would come to know. Then my accountant would sit with me, production manager would sit with me, and we will join our heads and we'll see where can we reduce our cost, because we have produced this bottle at 5 per hour, but we cannot sell it even at 5, you know, no profit, no loss. So either we would try to reduce the quality to save, to lower the cost of production. That's the first option. Or, you know, or some other sensible strategies where we can, you know, if we can lower the staff, if we can lower the number of staff that we have got. Say if we've got 25 people working in the supply chain, 50 people in the production department, we'll try to reduce the staff from 50 to 30 maybe. Things like that, you know, we'll try and do anything. And ultimately, if I'm saying, God forbid, if nothing happens, if we are still unable to reduce the cost, then eventually, obviously, our business will be shut down and we will have to close the factory. That's the only thing we can do. And the businesses do go bankrupt, and that's why they do, because the costs are above, you know, the selling price.
Yes, thank you, Professor. Oh, sorry. Yeah, and I was just going to mention real quick before we go to Mojisola Esther. You know, sometimes companies subsidize the original production because they might have a manufacturing plant in development. And so they might be producing at a small site. They might be losing $5 per juice bottle, but they don't mind because they want to establish a beachhead of market share. And they know that within 6 months or 9 months, they're going to be producing the apple juice at $1.10 once that new manufacturer comes online. And sometimes companies might operate something at a loss because it helps to promote other products that have a much higher margin. So they're okay to lose $2, $3 on, let's say, juice. Oh, but that allows the consumer to be aware of their 6, 7, 8, 10 other brands that have an 80 or 50% profit margin. So it's you know, it's kind of tricky to look at. There's so many things in accounting to learn at, to learn about. And a lot of companies sometimes, because of the assumptions they make, they get into trouble because they assume what's going to happen in the future, and then something happens.
Yes, that's why, Ricardo, always the accountants have to work in close collaboration with the production department, with the supply chain department, with the marketing department. They would go and say, we've got like 6 products, you know, but we want to introduce our 6th product, but we, you know, that is bottle of juice, apple juice. We are currently manufacturing it at a cost of $5, but we don't mind it selling at $4, you know, no matter. But if we get a market share, we are going to be a new entrant. If you're going to get some, you know, if you're going to get some, lots of people interest, and if the people will be interested to buy, you know, if you get them some market share, some good segment of them, some good proportion of the market segment, then we can increase the price later on. But that is the job of the marketing and sales department. The marketing and sales department, you know, the head of marketing and sales department sitting next to me. I'll leave this question to him and I'll ask him, okay, what do you say? We've got 5 products and now we've got this 6th product of apple juice. The cost of manufacturing is $5. We want to sell it at $4, and later we can, you know, we can increase it. How is this idea? The marketing specialist or the man who's actually who works in the field, who works, you know, in the entire city, who moves, moves around the city every day, 24/7. He knows that what will work and what will not. Then he or she is going to tell me whether it will work or not. So accountant have to obtain the information from everybody and then make that report, the feasibility report or the cost controlling report, to the higher management, to the CEO, that sir, I've completed this information. I've obtained the information from every department. That will be the cost of manufacturing. That is the assumption of the marketing department. That is the assumption of the sales department. And this is the complete financial information, analytical report, financial analysis of this product, of the feasibility, the financial feasibility. So that report will be presented, and then there will be another series of meetings, and then eventually a company decide whether or not to proceed with the production or not.
Perfect. Thank you, Dr. Abrar, for that. Esther, you've been waiting so patiently. Please, do you have another question or comment for our presenter today?
Yes, thank you very much. Thank you, Prof. Okay, so this is an unanswered question I asked earlier, and it is, what is there a difference between limited liability entities and an enterprise? And if there is, are their taxes treated differently?
Okay, what is the difference between an enterprise and a limited liability company? Okay, there are actually three types of enterprises. The one that is owned by a single owner, for example, sole ownership, that is called. If you've got a shop, of say shoes or clothes, you're the sole owner, and your tax rate will be different. Your tax rate will be different from what is being charged, what's being applicable to the corporate organizations. Your rate will be different. The second thing is what comes is limited liability. Limited liability can also be defined as, sometimes it can also be interpreted as partnerships. For example, if we have three partners and we all decide that if we go bankrupt, first of all we say 40, I invest 40, you invest 40. If you've got third friend who invests 20. Now the share we get into an agreement that we are whatever the profit we are going to get, for example, if we get a profit at the end of the year 1,000, 400 will go to you, 400 I'll be taking, and the $200 will be given to our third partner. These partnerships are typically limited liability. If anything goes wrong at the end of the day, and if we get bankrupt, what we are going to do? That's a wonderful page that you've opened. So what will happen if we go bankrupt? You will be responsible to pay 40% only. I'll be responsible to pay 40, and that the third partner will be responsible to pay 20%. And this limited is basically is limited liability. It protects you from the personal liability in most instances, your personal assets. For example, if you have got a shop, for example, if you've got a shop and you go bankrupt, the people, if they file a case against you, you will be supposed to sell all of your assets to repay the amounts that you owe to the people, to your suppliers, for example, if you're unable to pay the repayments of your loan to the bank, what the bank is going to do is the bank is going to sell your house. You will have to give up everything. What is limited liability? Limited liability says that all the business assets that I've got, my shop, okay, will be sold and will be given to the debtors. To the debtors, I will be paying suppliers to the bank, and the personal assets. Nobody can force me. Nobody can take me to the court to sell my personal assets, even if I fail in repaying to my debtors, right? And what happens in the corporate organizations, corporations? Now, what they are actually, they are listed companies. They're listed at the stock exchange. For example, if the Twitter or even the Facebook or the Microsoft, if these companies, if they go bankrupt today, their board of directors will not be liable to pay even a single penny to the debtors. Not even a single penny. If I'm the CEO of of Twitter, which is Elon Musk, I'm not. If the Twitter goes bankrupt, and and I say, okay, Twitter is bankrupt now. It's just lost all the money. Okay, and the people are coming to me, the banks and the other financial institutions from where I borrowed, big loans. They'll be coming to me and will be saying, okay, I mean, you're the boss of the company. I'll say, I'm the boss of the company, but this is a public limited company, and all the money that that shareholders invested in my company, that will be vanished. I mean, for example, if I am like I gave you the example of Enron company in 2000, if I had an investment of say $50,000 in that thing, at the end of the day, I lost. And there was another Ricardo, I mean, you must be familiar with the Ponzi scheme of what was that chap who worked in the Wall Street? Very notorious case of that chap.
Oh yes, Bernie Madoff, or
yes, Bernie Madoff. I mean, he made that, but at the end of the day, he was not responsible to pay to anyone. He was not responsible because he actually was responsible. Why he was responsible? Because it was a private firm that he was running. If that were a public company, or if that were a public limited company, then he would have run off without paying a single penny to the investors, to the shareholders. So but even then, it was a very notorious case in the United States. But and that's why you have to be very careful when you are investing in public limited companies, who are the companies that are listed on the stock exchange, NASDAQ, S&P Global. You go there and you see different companies, ExxonMobil, Kia Motors, Honda Motors. You go there and you buy the shares of different oil companies. You buy the shares of different other companies, of the Twitter, of Instagram, things like that, different tech companies. So at the end of the day, if these companies go bankrupt, I mean, their owners are not liable to pay you anything. They are not liable to. They're not liable to pay for your losses if the company goes bankrupt. But in a sole ownership, if you're the sole ownership, then the people are going to come after you and will ask you that you will have to pay. Otherwise, they'll take you to the court, things like that. In a limited liability, you will have to sell your business assets only, but not your personal assets. And in the stock exchange listed companies, which are also called public limited companies, work in a different way. Like I told you before, the owners of the public limited companies are shareholders. The CEO, the CFO, the chief executive officer, chief financial officer, chief digital officer, all the board of directors, they will not be liable to pay you even a single penny.
Fantastic. Thank you so much for that question, Esther. Okay, well, look, we'll give one more try to Obafemi. And that'll be our last question for the day, Dr. Abrar.
Right. Thank you very much. Happy about the presentation. But I just want to know, there's a mention of the blockchain technology and the fact that it has a part to play in the accounting structure. I just wanted to know the relationship between, why mention of that in the course of the relevance of accounting now for the business.
Okay.
I don't know if I'm audibly clear. Okay.
Okay, these cryptocurrencies at the moment, they are not subject to any, as far as I know, they are not subject to any tax. They are not subject to any regulations as of this moment, to the best of my information. But since they are not being, not being governed, since they are not being overseen by the regulatory authorities, so there is 100%. There is, there is a good thing and there's a bad thing. That the good thing is that probably that you would not be required to pay the taxes. You would not be required to pay the gain on the cap. For example, if the share price of Bitcoin was like, say, $100 10 years ago, and if the share price, if one share of Bitcoin today is like $50,000, there is a big capital gain. And if you sell that share, one share of Bitcoin, which was like 1,000 at that time, and now 50,000 at that time, 50,000 now. And on that you are not supposed to pay any tax as of this moment, as I know. But there is a lot of debate being going on because the central banks in most of the countries do not want to accept that, because they say that will be the end of the currency. Because this will be another currency, the digital currency, the anonymous currency, the cryptic currency. And that's why there is still lots of debate on this, whether they should be accepted by by the Federal Bank of United States or the Central Bank of England. There's lots of debate, but nothing has been decided as yet. But the way they have changed, because you can pay, because if you go to the Amazon, if you go to some other big companies, if you want to buy anything online, you can, there's always an option that you can buy either through your Visa card or so other digital payment methods such as Bitcoin or Ethereum. The options are available to you, so you can use them. So obviously they are a currency. There are some regulatory issues which have to be still solved, and that's why the central banks are not allowing this the digital currencies to be allowed in the mainstream central banking.
Fantastic. Well, thank you for that. That's definitely a new horizon for accounting. Lots of changes, lots of challenges and opportunity. I think it's a way for many people to save that 1 or 2% that they might lose whenever they transact internationally, which currently happens. And I think a lot of banks are already considering that in their models, and they're lowering the costs to transfer funds because they understand that customers nowadays can, going through a little bit of a trouble to opening a cryptocurrency account, buying a cryptocurrency, once that initial obstacle is overcome by the consumer, he may never turn back to a traditional bank ever to send remittances, to make payments, because the transaction cost is virtually zero or pennies. So you can transfer $1 for 10 cents or 2 cents, or you could transfer $1 million for the same 10 cents. So why would anybody pay a bank 1 or 2% to send money across the world, plus another 1 or 2% in the currency conversion when that's no longer necessary? So I think that's helping to lower the cost around the world, what banks are willing to charge. So that's.
But there will be a solution. But there will be a solution. Because this fight is going to end somewhere.
Yes.
It's definitely going. There will be an end result, because the people are making an awful lot of investments in the digital currencies, and obviously, you know, you cannot. This digital disruption that I presented in my presentation, this digital disruption has really shaken the core of the banking system, has really shaken.
Absolutely. Thank you so much, Dr. Abrar. I really want to thank you, and I want to thank the students who are still here with us today after a very, you know, we started a little bit late, but we made up for it in quality and content. So thank you so much. Thank you, everyone. And I want to wish everyone a good afternoon, a good night to you. Also, Dr. Abrar, I know it's evening time for you.
Thank you.